Hello everybody and welcome to today's video. So today I want to talk about Hims and Hers, the company, and it's a company that has been on my radar for a long time, but I haven't had the chance to look at it. Mostly because the products don't seem the products are not really the typical products that I would want to invest in. But nonetheless, these telehealth products sold through telehealth are very important, and there's a huge market for this type of product. So what does Hims do? Hims and Hers do? The website and mostly the app. What do they do? Well, they focus on more sensitive health issues, and they're health issues that are too often stigmatized in society. Hence, little interest for me to research that company. But I was wrong because this is a very good company. I believe they have a lot of good stuff going for them. Not investment advice, but I may buy the stock. I'm very interested. Uh, but it's on health issues that are often stigmatized in society, and it's oftentimes a type of issue where people may have been even reluctant to seek for help, where they just if you have hair loss, you just wear a hat and you forget about it. But nonetheless, they deal with a major market. ED is a big one. If I say Viagra or Cialis, it's obviously like a very big market. Hair loss, huge market for both men and women. This is an issue that affects both men and women. Then you have obviously things like anxiety drugs, things for sexual wellness. You have birth control that they're introducing now, which I think actually could be a really, really huge market. Things for yeast infections. These are all topics that are not fun topics, but nonetheless, there's like big needs in this, and so this company addresses a real need. This is a company that addresses a real need, and it's within the telehealth sector and the broader disruption of healthcare thesis, and we're going to see why. Um, but let me begin that by saying that these products usually, Hims and Hers sell products that usually require prescriptions, and they are recurring prescriptions. So what you would do is you would get the app, you talk about the health issue that you want solved. You fill an online form, and depending on the product you're trying to get, it could be either reviewed by a medical professional or you could have a consultation. But typically, within 24 hours, you can get an answer, or yes or no, from a medical professional and a recommendation. And then Hims and Hers gives you a subscription. So you could have a subscription for ED or a subscription for hair loss, and these products are shipped to you through a discrete packaging, and they have a very, very strong subscription business, because once you get the app and once you've subscribed, it arrives discreetly in the mail. You're likely to just keep going with these products because they address very real issues. Interestingly, they have two automated pharmaceutical warehouses, big warehouses in Columbus and Phoenix, and that's where most of their products are shipped. So that's even not that much of a direct competition with Amazon. They got their much of their warehouses covered here. Uh, I think one of the big distinctions between Hims and Hers and the telehealth space as a whole, because we'll see there's a lot of competition. One of the big distinction is that they try to become a consumer brand, a friendly consumer brand. App is really well rated. The name, frankly, is nice. Hims and Hers, that's a nice name. And they try to sell their products under the name Hims or under the name Hers. And then they say, oh, generic equivalent of a mainstream well-known drug. And so the main way to explain this is which do you think consumers that want these sensitive health issues resolved, would they just prefer say, oh, I use Hims, I have Hims, get Hims or get Hers, or would they rather say, oh, I'm on Cialis, oh, I'm on Viagra? These drugs, and I could go on, there's more drugs, have a lot of stigma, wrongly, by the way, but it's just the way it is. They have a lot of historic stigma attached to them, and if you say, oh, I'm just using Hims, it has less stigma. So I think it is more appealing in this case, and they're trying to create a healthcare consumer brand, which once again is very interesting and different positioning from a lot of the other telehealth services. Very different positioning. Uh, and again, I don't want to go too much into the details as to what the products do, but it's very obvious to me why these products are recession proof. And it should probably be obvious to most people why those products are in strong demand, regardless of the economy. If you have a need for ED drugs or hair loss treatment, depression, etc., this is so central to a customer's life. Of course, they're going to keep buying it during a recession, which I think is why the growth numbers are so well right now for hims and hers, despite the recession. Because sexual health or birth control is probably the last thing you're going to quit in an economic downturn. And this is another reason, as we are in the post 2020 era. In 2020, everybody believed telehealth was the big thing. Now a lot of people are saying, well, no, actually going into the doctor's office is the big thing again. And so all of these telehealth stocks have crashed. But there is one subsegment of telehealth where I believe it's obvious why doing it online is a better thing. And that is those sensitive health issues. Because I don't know if you've ever seen, for example, treatments for ED and low T, but overwhelmingly, it's something that happens in a strip mall. I mean, this is an example of a place where you would go to get a prescription for ED, and it's right next to a foot spa, and it's right next to a Jimmy John's. I mean, is this a little? I don't know who would. I mean, I think there's a lot of value in doing an app. I mean, to me, I don't see. Uh, I see men having a lot of value in just having an app and doing it in the comfort of their privacy, and not having to walk in to one of these stores. And again, this is not a criticism of the stores. I'm sure those stores are great, but it's like you would hope for something more discreet. You want something discreet for these sensitive health issues, and walking into a strip mall right next to a Jimmy John's is not very discreet. And what I say is that since this is the old way of doing it, uh, store in a strip mall for low T prescriptions, I think there's going to be a lot of induced demand. People that have not looked for help, who are now going to seek help and get help because they don't have perhaps a less than desirable experience going in public like that to a store. I think you're going to have a lot of induced demand for this type of product, essentially new demand that has not been catered to by healthcare. And so let me move on a little bit with a comparison. Uh, so when I did this research, I got bombarded with ads. Like every single corner of the internet targeted ads at me. Uh, and this is just a sample of some of the ads I got on different social media and internet platforms. And again, I don't think the branding is as compelling as a neat hims or hers. The branding is not that compelling. They use the name of the molecule, in a big way. They still call themselves pharmacies, right? And I mean, I don't know. Maybe I'm wrong. Maybe I'm the one who sees this, but to me, see then again here the name of the name of a chemical compound is put forward, and they don't put forward a consumer brand. This is not hims or hers. This is you go to this pharmacy that is undistinguished, and you're just going to get a drug from this undistinguished pharmacy or these undistinguished pharmacies. It's not just about cost savings. So again, of course, it's a competitive market, and they're going to take some market share. But the idea of creating a consumer brand that englobes all of these sensitive health issues in hims and hers, and so if you have multiple needs, you can use the same brand that you trust. I think is a very compelling offer, because even going to the pharmacy, that's not fun. That's not the way that a lot of businesses are doing today, where it's all about the consumer and the consumer experience, and offering great consumer experience. And that's a good transition to the apps. The apps have outstanding reviews. If you scroll through review, that's a 4.8 out of 5 out of 6.4 thousand ratings on the App Store. That's a really, really, really good rating for an app. This is Airbnb level type rating. People are raving about the service, raving about the app, and same for the women's version of the app. It's interesting to see that most of the business is still men, but they are also focusing on women. And it makes sense. I don't. I wouldn't want a business to only focus on half the addressable market. It's like hims and hers. They renamed the company quickly hims and hers because it was just hims. They're like, okay, we're gonna do both because you want to address the whole market. And this is the other known, quote unquote, known competitor in that sector. It's called Roman. And Roman is I would argue the one that's also trying to create a consumer brand. But I see a few flaws with Roman. First of all, it doesn't have an app, so you have to buy online. They're a little bit older of a company, uh, and so a little bit more legacy from the standpoint. Second of all, it's a very bad name. I mean, I'm sorry, it's very generic. Like if you type Roman online, you're gonna get a bunch of games for your phone. There's so many people use the generic name Roman. It's it's a you're European people of our past, of our collective past. So it's like, yeah, it's a very generic name. So when you do an online search or anything, I don't think it's a good name. But that's just me. And the last thing that I don't like for Roman, so no app, generic name, and then one thing that I don't like is that they solely focus on men. So of course, Hims is still the business is still mostly men's, but they're expanding to women because it makes a lot of sense. Why would you just focus on half the market? You should focus on the whole market. Your warehouse is built, your website is built, your app is developed. It doesn't cost much to add more onto your business, right? That's how you create economies of scope. And HIMSS is trying to constantly expand in different aspects of healthcare. So that was just a note on competition. And now let's talk about the fun stuff. So the numbers, right? That's the fun stuff. The numbers are outstanding. The numbers are just outstanding. Look at this growth. Year over year, you had 95% growth in a recession. I mean, this is the recession, I would argue, started in the end of Q1 2022, the beginning of Q2. And by the way, official recession is different from my perceptions of a recession and perception of a recession for a lot of market participants. Recessions are typically announced very late. We have been in a recession. And look, despite the terrible market that we're in, that we've been in, terrible recession that we've been in, they had a tremendous Q4. It's a clear acceleration. They've had a clear acceleration. This is as much of the beginning of an S curve as you can find. This is very, very, very fascinating to look at these numbers. But when I calculate it, right, and you may know if you've seen my other videos that I like to do quarter over quarter at the last quarter, and I like to analyze it. So we did 145 million in Q3, 114 million in Q2 of 2022. That's 27.19% quarter over quarter growth. And I can't, it's almost indecent for me to annualize that, but I will annualize it. If you annualize that, you had 161% revenue growth. So of course they may have a slowdown here and there, but they've definitely grown at more than 100% for a little while now. And so this is fascinating. When a company grows that fast, I mean, there's a it's very overwhelming. It becomes like gravity when a company grows that fast. So not investment advice, of course, but I love the growth, and the growth is accelerating. And to me, revenue growth is and will always be the most important metric of investing in any growth company and any company whatsoever. To me, let's talk about the headwinds, some of the revenue headwinds. Well, we have Amazon competition, but then again, Amazon has announced that they were going to revolutionize healthcare. How many times? Lots of times. I think Amazon has a plan of strategic attention. You need somebody that has full strategic attention to compete against you. And in the context of Amazon here, I'm sure there will be significant competition from Amazon someday, but that day is not right now. Or at least I don't see that in the number. The numbers are not telling me that. Roman, I just discussed Roman in the prior slide. Yes, Roman is also trying to become a consumer brand, but I've outlined the issues that I find with Roman. And then there is some overlap, not going to hide that, with Teladoc, especially on depression, and with GoodRx on ED. But GoodRx, you still have to you still have like a little bit of a pharmacy tone to a GoodRx. So there's some overlap. There is definitely competition. But the market is so huge. The market is so huge. Um, Before I go into the market, let me finish that slide. There is no concentration that I can see. It's recession resistant for obvious reasons, as I've explained. And most of the revenue is recurring. It's recurring revenue. They focus on those um, sensitive issues where you need a recurring drug to come through the mail. And so this is very appealing, right? Very, very appealing subscription business. Let me move on to the growth runway. And quickly, what do I want to say about the growth runway is they've estimated that for their top four products, so ED, air loss, and you may go to the website, you'll see the top four products. Um, they've estimated that it was $65 billion in 2021, the market. But the question that I have is, how can you know that these estimates are accurate? Uh, you can't really do a survey. You're not going to get good responses on a survey. So I guess what I'm taking is let's take this total addressable market with a grain of salt, because it may be much bigger than that, especially if you have induced demand from the fact that now it's sold through a very approachable app that is much more accessible, much more friendly, much more connected with the current times. So it could be a bigger runway, but I think 65 billion is what they said. I know it's what they said, and they're pretty conservative. And if you go with that number right now, with all of the growth that we've seen in 2022, right now they are at 0.7% of that growth. So just beginning. And I want to say that the market will be much bigger because hims and hers is adding products. They've added so much products for the hers side of the business. And they will keep adding product. And a product that I'm really following here is birth control. Like if they add birth control, I mean you're talking about a huge total addressable market, like an absolutely huge total addressable market. Gen Z millennials move from big city to big city. Like, I mean, do you know how long it takes to see a gynecologist in a big city? But it's not even funny. Like the if you can have a convenient app where you can just click a button and get the consumer brand, because I know these apps exist, right? I mean, GoodRx does that, Teladoc does that. But if you get the consumer brand and you get the logo, the very highly rated app, or you get reviewed in 24 hours, I mean, this could be a huge market. And they already have the warehouse capacity. They already have the website. They already have the brand name. So I really look forward to some of the products that they can add. I mean, this is a very exciting company that is going to really streamline the way we access healthcare and we access these more sensitive, more personal type of products. Growth. Let me go on with revenue growth. Is revenue growth healthy? Yes. Minimal growth by acquisition, none to speak of right here. And then marketing expense. We need to talk about marketing expense. Marketing expense is about half of revenue right now. Albeit a lot of marketing expense is stock-based compensation, and I am not like stock-based compensation does not take cash out of the business. It dilutes the shareholder, and I am more okay with that than cash. So I think it's actually a plus. But I realize not everybody thinks like this on stock-based compensation. Some people hate stock-based compensation. I don't. But I think what's more important when you look at marketing is the return on marketing spend. And this was from their investor presentation. And their marketing investments have a payback period of under a year. So if you put $1 in marketing, you get that dollar back in the form of your gross margin. You get that dollar back in less than a year. I mean, you have an incentive to plow as much money you can into marketing, and clearly they're doing that, and that's why they're growing so fast. Because these subscriptions, once you gain the customer and you've paid back your marketing expense, that customer is staying with you. 90% of the revenue is subscription based. So imagine you get a customer for, I don't know, hair for hair products or for ED. Imagine you get a customer like that, and the customer stays with you for 10 years. I mean, that's good, or more, and maybe buys another product. So it's a big deal. It's a very big deal, but very strong unit economics. And I am more than willing to accept the fact that marketing spend for hims and hers is an investment. It is a clear investment in this case. Let me move on. So, any near-term bankruptcy risk? Well, no, no. Negative cash flow right now at minus 19 million, and the cash on the balance sheet is 233 million. Therefore, it's about 12 years until bankruptcy. But this is perhaps even less important. These numbers than this is they are expecting adjusted EBITDA profitability in Q4, and that's adjusted EBITDA adds back all of these phantom expenses like amortization, depreciation, SBC. All of these are added back. All of these gap accounting spendings, which actually do not happen economically. They don't matter economically for us. So I like that they use that metric here. And Q4, we're expecting profitability on EBITDA in Q4. So we're going to have a very healthy business going forward with Hims and Hers. Let me move on. Gross margin, it's excellent. 79% gross margin is absolutely excellent. These drugs are so profitable. Wow, they're very profitable. You understand the size. I mean, I understand the size of some drug companies when you see those margins for a tangible product, which is it's a software like margin here, and the price to gross profit is very low, extremely low actually, at 3.87. It's extremely low. But as I always say, for a company that's just starting out its growth, looking at valuation to me is not too meaningful. Growth is what matters to me for these companies that are just growing. So for the sake of consistency, I love that it's very low, but it's not very meaningful. It's not very meaningful because it's a $1.3 billion company. So that company could be so much bigger than that. Debt. They have no debt. They are an anti-fragile company. They have no debt. They can't go out of business from their debt. So that's wonderful. The dilution, right? So when they went public, of course, dilution you get. But after that, it's been pretty stable. A little bit of stock-based compensation, but not too much. Insider ownership is 16%. This is excellent. And the business is founder-led. Knowing that this is a business that went from nothing to $2 billion in market cap when they IPO'd in less than 4 years. So think about the value creation. That's really, really strong value creation in this business for the founder. And the revenue per employee, I love it. It's almost $1 million, right? It's almost $1 million per employee, revenue per employee. So it's absolutely outstanding revenue per employee. Very productive company, very efficient use of human capital. This is quite good. Stock price, well, oh my God, the market, I can't even understand this market because this company is doing so well. The stock price should not look like that. There's no way the stock market should look like that. The stock is down 72% from its all-time high. Okay, it's a little misleading because I take the all-time high point, but still, it's down 32% since its pipe. They did like a pipe SPAC type of IPO. So they've been associated with the stigma that these companies have. No, and add to that they sell a product that I think most investors don't want to research because, these ads that I showed you are ads that are showing up in my internet. I don't know for how long I'm going to get ads like that. Perhaps 4 months. I don't know. If I end up buying the stock, probably a long time because I'll keep researching it. So maybe that's the reason for the low valuation, but it's a little ridiculous because the stock went down to 270 a share. I mean, for a company that is not only growing at 100% a year, but whose growth is accelerating, whose total addressable market is accelerating. I mean, this is not investment advice, of course, but I think this is very cheap for this type of growth. Although when a growth company is in the beginnings, you typically don't care about valuation. That's just the way it is. And to conclude, I may be interested in buying Hims. I'm going to study it very carefully because I own a bit of Teladoc, and so I need to assess my Teladoc thesis And I regret owning Teladoc because it has been a very poor performer. It's been associated with so many of these, I mean, so many of these stocks have been bashed, and it may make sense to take a loss on Teladoc and swap for HIBs. You know, I'm trying to shift investments at the end of the year so I can create losses, right? I mean, when your investments are down, you really want to take that opportunity to book losses and switch investments and say goodbye to old stocks, buy new stocks. This over a long run, this really increases your returns over the long run. You know, it makes it less hard for you to take profits because you've taken losses before. So the company is very compelling, absolutely very compelling company. And let me conclude with, can this company 10x? And the answer to that is absolutely. Not investment advice, but absolutely. That would be a $13 billion company if it 10x. And with a dollar of a dilution, you'd get the equivalent of 3.47 billion today. So the dollar is diluting. You know, that's why the channel is named Beat the Denominator, because my studies tell me that the dollar's value is dropping at a rate of 15% a year, no matter how much the Fed is bluffing. You know, commercial lending is still going strong. The deficit is still going to be very, very strong in 2023. The Fed's going to have to turn back on QE. I have no doubt of that in my mind. And so if a dollar today is more like 25 cents in 2032, then the stock would only be worth something like 3.4 billion in a value term. So yes, this company can 10x both in nominal and in real terms. It is a possibility. This is not investment advice, of course, but these growth numbers are, they can be very forgiving for investors. When you buy a company that grows this fast, um, you know, mistakes on valuations tend to be forgiving when a company grows that fast. And so yeah, they could be big. They could be big. But as always, not investment advice. This is just entertainment and edutainment. Thank you for your support. Thank you for liking if you can and subscribing. Please follow me on Twitter at Beat the Denominator. I have occasional threads and posts. And thank you so much. Have a great day. Thank you.